Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Today, we will be speaking about direct lending to private US-based companies. We hope to demystify the space. And with us today, we have Alona Gornick. She is a managing director and senior investment strategist at Churchill Asset Management, which is an affiliate of Nuveen, a $1 trillion asset management arm of TIAA. In her role, Alona focuses on private capital market insights and investment strategies. Alona, thanks for joining us today.
Thanks so much, Joe, for having me.
Yeah, I'm excited to discuss this topic today. A good way to start is probably to give a really clear definition of exactly what direct lending to private US-based companies consists of. What are the key characteristics of this class?
Sure. So when we think about direct lending, it really lives inside of a much broader asset class that's commonly referred to as private credit. So if we even just start at the top there, I'd say it's really important to think about private credit as a very long-standing, origins dating back to the 80s even, of what true private lending actually was back then, really insurance companies lending directly to private businesses. It's really taken on its own form as it's grown in size, particularly from the number of participants involved in private credit today. But when we think about the asset class and its sheer growth, and we'll talk about that later, we've seen it, really meaningfully grow, probably 5x since the great financial crisis and double since 2015 now to about $2 trillion as a broader asset class. Direct lending lives inside of that private credit sort of umbrella. And next alongside it would be a variety of privately negotiated like loans, right? Where it could be performing on the direct lending side to distress, stress, special situations, all done privately, living within private credit, infrastructure debt, real estate debt, venture debt, all done privately. So when we think about direct lending, we're gonna cut through all of that and think about it. These will be loans directly negotiated with the borrower, between the borrower and a source of capital. Now, the borrower here will typically be a small to mid-sized private company. They may be private equity owned or not. And then the source of capital here will typically be an alternative asset manager, an insurance company, a lending platform that has a number of funds or fund structures where institutions and investors, individual investors, can come in to that lending platform and really represent that source of capital.
Thank you for that. So it's really interesting because I think there's, if I heard you right, two evolutions that took place. Evolution number one, and you kind of stated starting in the 80s, but evolution number one is a different constituent investor, because initially it sounded like you said it was really insurance, maybe pension, I don't know.
Yeah.
And now there's a lot of retail in it. And that's one of the reasons we're talking about it today.
Yeah.
And then a second, which we may not have touched on that intro, is that asset managers are doing a lot more issuance, or I don't know if I should call it issuance or direct investing, as opposed to banks. I don't know which one you want to take first, but I'm curious to kind of unpack both of them. Yeah, go ahead.
Yeah, so I'd say alongside insurance companies doing this back in the 80s, there, was more of the role of small to mid-sized banks lending, like regional banks lending to small to mid-sized companies. And back prior, call it the 90s, and if you look at the data through to even 2008, right before the crisis, there had actually been the start of massive consolidation happening in the bank space, right? It was meaningful M&A activity, really reducing the number of available capital sources or banks to these lenders, and really shifting their model to gain more profitability to do bigger deals and essentially somewhat move a bit out of that core direct lending type of activity in terms of profitability, or what would be most profitable for them to serve as more that middleman, where you can put together a very large loan, syndicate as much of it as possible, and take your fee. So you don't have to hold it on balance sheet. So as these banks got bigger, consolidation happened, you see that sort of move away. Now, when the GFC hit, you get regulation coming in to really try to support and create stability in the banking system in the form of Basel III and Dodd-Frank that really ended up increasing the restriction around lending and increasing the cost to even do so, increasing the minimal capital requirements that banks had to have. So in doing so, they actually took banks more out of that direct lending game because it was viewed as a potentially higher risk type of asset to hold, and it would be very expensive to do on balance sheet. So you really combine those two alongside of really interesting parallel demand for the borrowers that are supported not only by private equity, but mostly by private equity, to really look for sources of capital. And that growth, that demand for certainty, speed, execution, confidentiality, that was all coming alongside banks moving out. So you really have this void, this runway for direct lenders to step in and fill that gap. It's been pretty fascinating to happen all at the same time.
Yeah, no, that is fascinating, and I want to unpack it further, and I want to summarize because I think I heard it all, but let's start on the bank side. If I sum it up right, let me know. Item number one that happened is that there was consolidation within the banking industry. And based on that, banks wanted to do larger and larger sizes because there's some sort of economies. And so if you're a tremendous bank as opposed to a regional or Main Street bank, all of a sudden it doesn't move your needle to do a very small deal. You're not set up as well. And so you're just getting larger and larger deals. So that's item number one. And then item number two was the great financial crisis. That's GFC. Great financial crisis happened. And then in reaction to the great financial crisis, increased regulation occurred that resulted in banks being even more, they just had to go even bigger size to just make the economics work. So that's that was one part of it. It was, I think the beginning it was regional banks and insurance firms, and those regional banks had to go just bigger and bigger in size, which created a hole.
Yeah.
That's right?
Yeah.
Okay. So now going to the investor side.
Yeah.
So the regional banks went and lent money to these private companies. Were they back in the day pre-GFC, all the way early on, were they securitizing back then, or who ultimately, were they just putting it on balance sheet because they could afford to do that based on regulation? Like, who is the ultimate consumer at the end of the day?
I'd say it was typically on balance sheet and clubbed up amongst other small lenders that could do it together.
Okay.
Probably wouldn't just do it solely, but at that point, the size of the borrower on average wasn't the size that we see today. I think the size that we see today in private credit was really an opportunity set that the lending community has created. Because we've gotten bigger, we've created a new market of borrowers. Private companies staying private for longer. Massive size companies that don't have to go public anymore because they're now private capital access points available to them. They're much larger in size. So back then, if it was smaller borrowers borrowing from smaller banks, it could absolutely be done in much smaller, modest amounts of leverage and in club format. Lightly syndicated, if you will, but not as cost prohibitive. Certainly post-GFC, that really changed. But back then, it would really mostly be in the way of the banks. I'd say some insurance companies were doing it here and there. TIA was doing it. Pru was doing it in terms of more mezzanine finance, maybe not senior direct lending, but in a way where they would do it directly with the borrower.
Got you. Okay, so now the consumer or the investor is increasingly becoming retail. Is that correct? And so now you have still the insurance companies, pension companies, the like, I'll call them institutional investors.
Yep.
That's number one. And banks are holding a much, much smaller subset. Some amount is getting securitized, and we're not even going to touch that. We're going to throw that in the garbage. Another conversation for another time.
Yes.
But then you have this retail investor that's consuming a larger portion of it. And at the same time, asset managers have come in place of regional banks. And could you, how did that happen? Did one happen before the other, or both? Was this a function of characteristics of these where retail were looking for something? I'm giving some of it away, of characteristics of variable rate, so it feels like a quote-unquote enhanced yield as compared to where public markets were. What kind of, or was it created by the asset managers, where they created the demand through marketing, or some subset of all of them?
Yeah.
How did it play out?
So my sense of the evolution of where we are today, I'd say in the past 15 years, my sense is that it really started more so on the institutional interest side, where if you rewind pre-2022, we were in this low to zero rate environment. And institutions like insurance companies were looking for yield. And they know fixed income very well. They do it all the time. How can I get more yield out of fixed income, above fixed income, but it's current income that I need to serve my massive GA appetite, right? And they found their way to private credit. A nice yield advantage there, 150 to 250 basis points, but gives me similar features like current income, but some amplified elements with less volatility because there isn't that headline risk. There's no trading on sentiment. And then there's also really nice diversification because there's little to negative correlation with my public market assets. So they are meaningfully getting into private credit pre-2022, pre-2019, like in this massive decade before when we were in a low rate environment. And the access points for institutions were really through funds. These alternative asset managers or direct lenders that would have, high minimums or separately managed accounts, meaningful, like hundreds of millions of dollars to do private credit. When you fast forward to 2016, 2017, 2018, 2019, the onset of retail really has only come through by way of accessibility. So the asset class's features or benefits that are very attractive to institutions should be attractive to individuals, but there just was no access point. The funds did not make sense for individuals who have more of a need for that liquidity, that psychological need to get in and get out. You did not have that with institutions who are very comfortable with long-term, locked up, $5 million minimums. They were doing that all day long. But the onset of new fund structures, the evolution into really meeting an untapped kind of channel of capital, was that evolution of let's create fund structures by the way of asset managers that can be more accessible. Let's lower these minimums. Let's create some liquidity features, but in a way that we can control. And, let's allow for investors to come in and get invested right away versus committing capital and drawing over time, because these are very difficult for individual investors to have to navigate. So I do think the onset of retail, and it's still coming, it's very, very light. I feel like we're sort of just scratching the surface on the retail wealth side. If I compare the two, institutional appetite for private credit, I'd say just even alts in general, 25, 30% of their portfolios are very comfortably allocating towards alts, whether that's private equity or private credit or real estate. Inside of that, for private credit, you could see anywhere upwards of 10 to 15% just in private credit. That's a comfortable space they've been in. For retail wealth, it's like 0 to 2, okay? I mean, anyone that's maybe doing it today is probably getting comfortable with maybe 5, maybe 10%. You do have some very large institutions that are getting comfortable from a model perspective and offering that to their clients, but it really is a completely different ballgame in terms of that appetite and the uptake on private credit.
Yeah, a really interesting statistic just on the uptake of it from a Fidelity study talking about institutional versus advisors. Advisors, roughly 35% of advisors use alts, and it covers about, on average, 5% of their portfolio as compared to institutional, which is closer to 100%.
Right.
And those numbers go up 25, 30. Now, granted, institutional are larger, so they They have maybe more capabilities to have this illiquidity,
Yes.
et cetera, but still really low uptake, and it is definitely driving up. It's moving up, so it's interesting, and that's why this conversation is so relevant, because I think more and more people will consume this product. But I want to go back to where you started that answer, which is institutions drove initial interest based on preferable characteristics given a low rate environment. So institutions looked around and they said, hey, this 1%, 2%, 3%, that's no fun. I want more.
Yeah.
And then 150 to 250 basis points, 1.5 to 2.5% extra additional to take on risk. And then one other element, which is public market rates tend to be fixed, and these are variable rate,
yes.
correct?
Yeah.
And so variable rate, if yields go up, in a variable rate, because it's variable, yields, your returns go up.
You benefit, yes.
You benefit. And in fixed, you don't benefit because the value of your holding goes down.
Impacted, yeah.
So you get impacted by it, and that's a big.
So it's a natural hedge for inflation and that floating rate dynamic. So if it's institutions love the current income aspect, the natural hedge on inflation, they like the diversification into the portfolio because of the lack of correlation, and they like the lack of volatility. I'd say the last piece that they uncovered, institutions that is, in doing all this research, working with consultants to get comfortable, is a remarkable resilience of the asset class and the data they were able to obtain in terms of very low loss and default rates relative to what they've been comfortable with taking on in terms of risk for high yield and publicly traded loans or broadly syndicated loans. So if you marry up those 5 characteristics of key features that institutions have uncovered, it's now a matter of just time on when individual investors can and should and would also be able to access this asset class and what vehicles will be created for them.
Can you just label one more time really quick the 5 characteristics
Yeah.
you just laid out?
So I'd say current income, the inflation hedge, natural inflation hedge, so it's floating rate in nature, diversification, right, through that lack of correlation, low volatility, right, given that these are buy and hold investments, they don't trade on a secondary market like public markets do. And then last, I'd say resilience in terms of lower loss, lower default rates.
Right,
so really, if you were to take that last one, I'd say a very attractive risk-adjusted return because you are getting a yield premium here married up with a resilient asset class in terms of losses.
Excellent. So I want to come back to a few of those. But one item that kind of played out, or one scenario that played out, is that this class has really ballooned in size. And there's a concern out there saying, oh my God, this has grown so quick. What's going on here? Is there too much money chasing it? Are there too many people taking loans? Or what's going on? And I'm curious if some of that is just almost a mislabeling, because if you look at just asset management, you're like, okay, it started at 0, but it replaced regional banks. So some amount maybe switched. So I'm curious to understand what the true growth has been and how you feel about that general concern.
Yeah, I'd say it's an interesting way to think about growth. What's net new versus what was done by somebody else. I think there is certainly a lot of net new capital that has come into the space. But when we think about it, there's 2 sides to think about growth and heralding the size of the asset class. On the one side, there are proponents of it within industry where we want to see and talk about this being an established asset class, throwing around figures like 2 trillion, 2.1 trillion of a private credit broader asset class, because that means it's large enough to rival the high yield bond market. It's large enough to rival the public credit market, the broadly syndicated market. So you can't ignore this as part of a potential in your portfolio. If you're already doing those, why would you ignore this massive asset class? But on the other side of it, that $2 trillion number doesn't necessarily mean the entirety of the asset class has grown, because inside of it, direct lending, which is where we're really laser focused at Churchill, is only one piece of that. I'd say it's maybe 40-50%
Okay.
of the 2 trillion.
So it's about $1 trillion, 800 billion,
Yeah,
to $1 trillion?
yes,
Okay.
exactly. And in its own growth rate has probably shown more modest growth. So you've got different pockets driving growth. I'd say this is probably the largest driver, but we are certainly seeing a lot of interest now in asset-based finance. That's
Yes.
within private credit. So private credit as an umbrella is certainly growing quite a bit, but we're not all doing the same thing, right? The investment managers pursuing private credit strategies have different swim lanes, I call it. Not only on the sub-investment strategy we're pursuing, but even within direct lending. There are many flavors of direct lending where we really don't cross over in terms of what the ideal borrower for us looks like versus another lender's ideal borrower. So that's a long-winded way of saying there is a lot to go around in terms of potential opportunity to put and deploy capital in private credit that despite the amount of capital that has been raised, it is really falling short in terms of the potential demand that is out there to put that money to work. And I look at demand by the basis of mostly the private equity amount of capital that's also been raised that has to be deployed. Because, and we'll talk about this
Yes.
later, but that is a true driver of demand for private credit.
That's perfect, because I was about to get right into it.
I
We're
felt
not talking
that.
about it later, we're going to talk about it right now.
Okay.
Flavors, I like the term flavors.
Okay.
So explain, well, let me start with this. So private credit, $2 trillion, direct lending, 800 billion to $1 trillion. Of that, how much of that is quote unquote sponsored, which I'm going to have you define right after, or if you have a ballpark. Is it mostly sponsored?
Yeah, I'd say the numbers we've seen are typically around 75% or so. So 3/4 of direct lending is really transacted with borrowers that are backed by private equity firms. Typically those fully owning or majority owning and controlling that business. So that's what we mean by sponsor-backed private credit.
So can you go a little bit more into that? So sponsored is private equity backed. It's an equity investment. They're essentially buying out a company. Is that correct?
Yes.
And yeah, go into it if you don't
So
mind.
it may be helpful to maybe give an example. And I was thinking about it when I was walking around the streets of New York and looking at the massive number of cars. I would never drive in the city, by the way. But
Smart.
if I had to, because I was forced to, I would have to put the car somewhere and I'd have to put it maybe in a parking garage. There is a business that is private equity backed that actually manages the parking garage system, the technology behind it. It's not the owner of the actual parking garage itself, but it's an outsourced, like full turnkey solution for that asset owner of the garage to say, hey, I want to make money off of this. Can you help set me up with the turnstile, with the app that people can pay easily through the system? And it happens to be a middle market sized business and really rapidly growing. As you can imagine, the ability to buy and use this vendor service across multiple parking solutions and garages is enormous. So private equity backed. The private equity firm that looked at buying this business was going to do so by using capital within their fund, right? The equity in the fund. But they didn't want to use 100% of the equity to pay for the businesses. It'd be great if they could borrow some money from a partner so that can help amplify their return over time in this investment. So they look to partners, private lenders, and typically what you'll see in a capital structure historically was call it down the middle, 50-50. There's going to be debt on the business of 50%, and there's going to be equity in the business, about 50%. We've seen a shift more towards a sort of lower amount of debt, higher amount of equity, call it 40-60, particularly in this environment where rates are very high. It's very expensive to have that much debt on a business, so we'll use less of it. Lenders will provide less of it. But if you see historically 50-50 debt to equity, what that would mean is every dollar of private equity capital deployed would signal an equal dollar of demand for private credit, because typically you will see debt involved in the vast majority of these transactions when the private equity firm is looking to buy, not only at the acquisition of this business, but as they grow the business. So the private equity firm does not want to just buy the business and have it flatline. The way they will grow is both organically and inorganically through M&A, right? They're going to look to buy other smaller competitors and typically debt finance those purchases. So there's room to grow as a debt partner to the private equity firm through incremental financing opportunities to an asset that you underwrote from the very beginning when it was small, and it's grown organically. It's got 3 acquisitions it can pursue. You re-underwrite the business and say, hey, it's larger, it's more diversified, it's the same private equity firm, it's meeting its milestones. I will absolutely lend more to this business at this point in time. So you think about private equity as a really leading indicator for current and future demand for private credit, and you think about how much private equity dry powder is still sitting out there that hasn't even been deployed. We think about that as in the ground demand for private credit. Now, the numbers are all over the place, but if you looked at buyout funds and the amount of dry powder they still haven't yet used, I think the number's anywhere between $600, $700 billion, predominantly in the US middle market, true buyout, not venture, not big buyout, but maybe middle market. And then you look at how much private credit dry powder is sort of sitting, because you said we've raised a lot. There's a meaningful gap. I'd say about $450 to $500 billion of a difference between the amount of private credit that we all feel like is being raised and the amount of private equity that's already raised and sitting out there. So if I think about $500 billion of already in the ground demand that has to go somewhere, or else those private equity firms would have to return the capital to their LPs that are waiting to get called, that wouldn't be a good day for them. That means that we've certainly got room to run on the private credit side of those transactions.
Yeah, it's interesting. I mean, I was thinking that there's a potential concern on the private equity side, considering there's so much capital that needs to be put to work. If you want to be a jaded, skeptical person, you'd say, well, these managers don't get paid unless they put it to work. But then there's a reality of the vast majority of payment for these managers comes out, it's performance-based. Yeah. At the end of the day, it's not actually
they're highly
incentivized.
Yeah.
So they're very highly incentivized to actually create performance. But again, that's another, concern number one out there when you start looking at, and it's right to look at concerns, right? That's
sure.
how you understand it's due diligence of what are the risks in this investment. You need to go in eyes wide open. Concern number one is this ballooning? We spoke about that. Another concern is there too much capital chasing, which may create some unfavorable characteristics. And it seems from what you just said that you could try to make a case that maybe there's some concerns on the private equity side because there's a lot of people chasing it, but it seems like there's not even enough private credit money to you actually have to, it's a constrainer of sorts. Am I right with that? Or
yeah, I feel like there's a misperception around crowding and competition and growth and popularity and bubble. Like all these things sound very negative. But when we go underneath the hood and we look at the actual dynamics of an individual transaction where you have a private equity firm pursuing an asset, a business they want to buy. Yes, when they do this in auction, where there is an investment bank involved and they're putting a business up for sale and they're inviting 50 private equity firms to take a look at it. Typically only one wins. So it's narrowed down. They have to meet management. They do all their work and they figure out who is actually going to own this asset. So that's a lot of competition there, but they've been going through that for decades. That's what the process is, right? On the private credit side, I mean, there's thousands of private equity firms. On the private credit side, it may feel crowded and overpopulated, but there's typically 2, 3, 4 lenders in a deal to the one private equity firm that's won it, right? So we are all not just taking a sole position in that one deal, like a 1-for-1. If the one private equity firm wins, then only one private lender wins, right? So there's that's just going under the hood. There's more to go around in terms of that element at the transaction level. But if you step back and think about what drives that transaction level, where the private equity firm's looking for white space, middle market sized businesses that are private. In the US, there's over 200,000, okay, closer to 300,000 mid-sized businesses that are actually, generating revenue, generating a nice profit, anywhere, call it, 100 million to a billion, right, of profit that are private. That is far outnumbers the number of publicly traded companies out there. What are there, 6,000? Okay, 200,000 middle market businesses that are ripe for growth, ripe for acquisition, need capital to do that, and only 6,000 publicly traded companies that equity managers that trade back and forth constantly, right? Of the 200,000 businesses, do you know how many have private equity backing today that have had any institutional capital come in?
Oh my Lord, it's probably a very small percent.
It's a small percent. The way we back into it is if you think about, call it 1,000 to 2,000 private equity firms just focus on US businesses. And, in the mid-market, fund sizes anywhere from, 800 to 2 billion, 3 billion, like in that zone. I mean, there are certainly big buyout, 10, 15, 20 billion, and they typically will own about 8 to 10 portfolio companies. So call it, 8 to 10,000 businesses that are living within private equity, that have private equity backing today. 10,000 of 200,000, that's about 5% of just 95%, meaning white space that hasn't yet had any investment from private equity. That's what private equity's undeployed capital is looking to pursue. So in terms of are we crowded, the demand is extreme in terms of future demand for private credit and private equity because there's so much more out there in the US in terms of middle market, great borrowers, great investment opportunities, both on the debt and equity side, that private credit and direct lenders will really benefit from as we pursue those.
Yeah, that's really interesting. That's a nice way to just kind of frame it. If I guess what's going through my brain, so let's just call it 5 to 10%.
Yeah.
And if you think about how private companies generally play out, it could be family owned. A lot of them are family owned, groups of people, and at some point, it sizes out in a few different ways. One way it sizes out is it just may be too expensive for individuals to buy. Another way it sizes out, where I think private equity really plays a large role, is you hit up against how do I manage this larger and larger entity and just specialization. And it's weird, you'd think, okay, I have a lemonade stand and I made $10 in front of my house. Well, if you make $10,000 or $100,000 or $1 million, it's not rinse and repeat. There's so much more process that goes into it. It becomes very complex managing groups across the country as opposed to in one location.
Oh, yeah.
Et cetera, et cetera. So very few of those aspiring 10-year-olds who start the lemonade stand could go and keep on graduating, and that's where PE. So there's all these elements that PE actually helps beyond just money.
Oh, absolutely. The professionalism, the operational lift, top grading management, regional density, national density, pricing strategies, optimizing, how you're even looking outside of the US. But I do think there's way more that private equity helps with outside of just capital and the ability to just grow for growth's sake and buy your next competitor out, but the standing up of a real platform, of a real business. And then they're typically incentivized to sell or harvest this business at some point. In the middle market, you aren't as dependent, given the size of these businesses, on seeing your exit through IPO. So what's been really interesting about being a private credit partner to the middle market, that direct lending, is that we can finance businesses when they're owned by one private equity firm for 4 or 5 years, and then it sells to another private equity firm, and we still have the opportunity to lend in that new transaction. And it can sell to a third private equity firm. And we know it now for 8 years, when it was like a baby and became a toddler and the preteen and the teenager. And it's us continuing to deploy new money, into these assets as they grow.
Interesting. And so you've thrown out the term middle market a bunch let's define it.
Sure.
I mean, I think people may have an idea, but let's define just that. How is the market segmented? How do you think about middle market? What does that really mean? Yeah.
So there's no universal definition for the middle market. I think those in industry attempt to try to classify or characterize what are they targeting. So at Churchill, when we think about the middle market, we think about it in terms of three segments. A lower segment or lower middle market, call it sub 10 million, 10, 15 million of EBITDA or the cash flow that the business or the borrower will generate. And then an upper middle market, call it above 150 million, maybe 200 million of EBITDA. And then everything in between we think about as core middle market or traditional middle market. We call it traditional because it's where we've been for the past now 20 years, where the asset class it originally started when we were talking about that middle market kind of size, but the market has certainly grown to do more for bigger borrowers. But those three segments, and the reason why we think about those three segments differently is the borrowing characteristics, the transaction characteristics actually align more so within a segment. And what I mean by that is in the core middle market or the traditional middle market, what you will typically see are modestly levered or low levered deals, low being low debt to EBITDA or the cash that the business generates. You'll typically see meaningful equity contribution from the private equity firms, low loan to values, 40, 35, 40%, 60, 65% equity. And then investor protections within these credit agreements that are important to see for this size business. Financial maintenance covenants versus just incurrence that you'll see in like the high yield space. As you go smaller, you might see even tighter restrictions around the characteristics. So maybe 2 financial maintenance covenants versus just 1, maybe even lower leverage. And then in the upper middle market, you tend to see some of those investor protections get negotiated away. Maybe it's more covenant light, but these are much bigger borrowers. You maybe see a bit more leverage because they can get that. They have choices in the upper middle market. They can look at the public broadly syndicated space as an avenue for capital and the direct lending space. So there's really a really different kind of dynamic in terms of the transaction that you see there. But by and large, I'd say for lower and core, it's very relationship driven in how you source the transaction. You're not really calling one big bank to get your fill of a deal. You actually have to have a direct relationship with the private equity firm who knows you. You've done 3 deals together. They're going to call you on this 4th one, the 5th one. I mean, it's built over time. In the upper middle market, because these borrowers have had financing sources for a while, they can go to banks. There's different ways that they can get that capital. It is still relationship driven, but it's a bit more efficient, I'd say.
Thank you. And Churchill really participates in that middle market. That's where you guys are.
Yeah, right in the middle of the middle, I call it.
Right in the middle. Okay, amazing. Well, that was very helpful in that, and it goes right to another question of mine, but I just want to, what you outlined, which I think is really interesting, is starting with public markets. Public markets have all the access in the world. There's lots of participants. There's lots of data. Then you're going to the next size, and you go all the way to the smallest size, that sub $10 million of, let's just call it cash flow rather than EBITDA, similar enough. And it makes total logical sense that as you go lower, you're going to need more covenants.
Right.
You're going to need more protection. You're going to say, okay, these are the rules that we're playing at. And as a lender, you have more capability to do it. And it's justified to do it to protect yourself. And so you kind of, because that's a concern out there is this concept of covenant light, which you pulled up when talking about upper middle markets. And what covenant light generally means is that lenders are not doing what they used to do in terms of demanding covenants. Is any covenant light creeping into middle markets, or is it really in upper middle? And how do you feel about that? And how you
kind of like evolution? Yeah, I'd say so. The covenant light feature it's not a bad thing. I'd say it's just something that should be reserved for those highest quality borrowers where you feel like high conviction around free cash flow generation, high conviction around revenue visibility, margin expansion versus contraction, this business, how it performed through previous cycles, has it been around, all these things. So you get comfortable with going in a covenant-light manner. And those are typically reserved for that upper middle market. To your question about, are we starting to see a little bit of that kind of deal structuring looseness, if you will, come down market into the core middle market? And I'd say it ebbs and flows. I'd say more recently around the perimeter, if you will, but not broad-based, not in any kind of alarming way necessarily, but probably more so for businesses that start at this size, but are being pursued by a private equity firm who typically focuses on upper middle market deals, but has found a great opportunity in this segment and has a clear path to growth, and they want to get it there quick. And they're calling their lenders that they always get covenant light on, and they're asking them to pitch a financing term sheet for this size asset that happens to be in this zone for right now, but they want it to grow quickly. So I do think it'll be kind of selectively, or the highest quality mid-sized kind of borrower that will attract terms like that. But that's kind of where we're seeing it today in terms of covenant light, somewhat coming into the core middle.
Okay, thanks. And so we started this conversation speaking to twin evolutions. And one of the evolutions was the type of investor in this product. And something you mentioned is that structurally, Wall Street, Main Street has to build up to allow it. So we're coming towards the end of the show. It's been great, but I feel, and I argued with myself internally for the last 3 minutes, like, okay, do we bring it up? It's worth I think it's so important for our listeners to at least touch, call it a teaser.
Okay.
A teaser question, but really touch on structure. You mentioned, insurance companies, et cetera. They have one big pool of capital, and you said, okay, they're investing 200 million, 300 million, some huge number. And you could take high net worth, ultra high net worth. An individual client may invest 10,000, 100,000. An RIA may invest $500,000, $1 million, 5 million, 10 million, much, much smaller numbers. Yeah. There's other necessities. And so structure is so incredibly important. It's one item which we spoke about most of today, which is what is the exposure, and then how you accessing that exposure. So we'll just touch on it. So a little bit of a teaser, but talk to me a little bit about the different structures that have kind of grown up recently to provide access to retail.
Yeah, so I'd say structure's taken on a few forms. First, I'd say the business development company structure has been a really great window or access point for wealth. The earlier version of the business development company really launched kind of in a private phase and then could stay private for forever, right? It moved into a private that could go public at some point per the prospectus. So there would be a liquidity event for those investors, and then it would be freely traded on the New York Stock Exchange. And now we've got an evolution, sort of 2.0 in the business development company or BDC space, where there are now BDCs that are launched and filed and launched that actually don't ever have to go public. They're perpetually non-traded. They file quarterly. All the information is available. You come in via subscription, but your liquidity, since it's not going to be publicly traded at some point, is afforded to you via a repurchase program that's set in place, and the outline of which is typically quarterly. And it'll be up to an amount that anyone in the fund could get out up to a certain amount. So that really sets a table for optionality around private credit exposure. Do I want private credit exposure in an in and out fashion where I want a publicly traded BDC that are now all available by ticker? But I will have to deal with the headache of volatility and what does the market think this NAV is worth versus what I do feel it's worth, versus a perpetually non-traded BDC where you're actually getting private credit exposure, no public market volatility, that current income, the diversification, the deployment characteristics that you're looking for. You can top up, you can control your destiny on adding capital to it with different minimums than the earlier form of BDCs. You also have interval funds which are probably more accessible from a daily. There's a ticker involved, accessibility to it that's a lot easier than these non-traded BDCs. You also have access funds that allow you to get into a main fund, an institutional fund, but at a lower minimum and maybe different rate or fees. But it does give you that access point. And then I do believe that there are a host of ways that we are seeing asset managers trying to partner up with banks and see if we can get this more in the form of ETFs and into 401ks. So I think that the further we think about access points, it's going to be pretty exciting to see this kind of broadening the exposure for private credit.
That's great. And so a theme we constantly talk about is that there's these incredible benefits from just the creativity of Wall Street and these variety of structures, but inherent with it is complexity. What's right for one client may not be right for another client. What are the right exposures in there, et cetera, et cetera. So it's big and broad and great, but also really, really complex.
Yeah, I think the biggest thing that I run into on the road is that education is so critical. While there's so much optionality now, there's created an even greater need for education, and that education process is very, very long. There's the what is it? Why do I like it? And what should I be worried about? And each of those takes a very long time to get comfortable with. Once you understand what is private credit, then it's a matter of understanding why do people like it? What are the benefits? Why should I add it to my portfolio? And then when you're like, okay, I'm going to do this, but what should I be concerned about? So education is absolutely a part of this, and fund managers are really trying to lean in, invest a ton in research, data, white papers, anything from doing podcasts, like as media is getting involved to try to make it better, demystify, and make it more of an asset class that while there's a lot of optionality, there's a lot more to learn about it, and making your choices is really important.
That's great. Let's end with this question. If for those advisors and clients who don't want to spend a ton of time educating, what's 1 to 3? Give a couple items that you believe, as people look at this class, that they should focus on.
Yeah, so I'd say in terms of getting comfortable with the asset class, really manager selection is critical. I do think there are no two portfolios that are going to look just alike, because we all have a massive universe of opportunities to deploy capital. In the public markets, there's probably a lot of similarity, a lot of concentration going. There's benchmarks. We don't have a benchmark in private credit. So manager selection is key. And when you're diving into managers, I think you should really understand what is your strategy and why did you choose it? Why do you choose to stay there? I think the second thing to really understand is don't just assess a manager by their best investment. It's going to come, but assess them by maybe their toughest one. They're more challenging. Like look at their ability to avoid loss. Because at the end of the day, this is debt. We're really not aiming for upside here. We're looking to avoid loss. So what does that track record look like? Talk to me how you've walked through that, and what were your lessons learned on that? And then I'd say, because there is so much more in terms of data and choices out there, really do your research, because you can actually find outliers. Like what's the average? Who's above and below? That data was not available before. So I do think understanding the variety of metrics that can signal weakness in a portfolio, any aspects of portfolio health in terms of deteriorating quality versus upgrading, all of that, find out what those metrics are. And the last thing I'd say, because this is all relationship driven, is for a manager, how do you source your deals? Because sourcing is your destiny. These aren't found on a Bloomberg. What is your true advantage in your swim lane that you chose, in your sponsored, non-sponsored? What do you do that's different from others? And really, how do you back that up?
That's awesome. Alona, thank you so much for joining us today. Everybody should check out Churchill, learn a little bit more about it. Thanks again.
Thanks, Joe. Nice to be with you.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast at fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.